Hello, it's ChewDog Charts. If you want to figure out whether the stock market is crashing or just correcting, you need to be more than just a math whiz. You also have to have a little experience. One of the defining characteristics of past market crashes, like those in 2000, 2008, and even back in 1987, was that everyone knew they were crashes. You didn't need to figure out percentage decline from the high or check the latest economic reports for signs of a recession or runaway inflation. You didn't need to scan the charts for breaks of key trend lines or moving averages. You just knew. Meanwhile, with regard to the recent weakness, many pundits have been quick to point out that pullbacks and corrections are a normal and healthy part of a bull market. The current sell-off only seems different because it was long overdue. Well, I think it's a little more than different. And to me, because I feel that market conditions are changing, I think it's time that you have a game plan. So let's take a look. On February 5th, the Dow dropped 1,175 points, which was the biggest one-day Dow point drop. Today's drop of over 1,000 points should score second on that list. And although impressive on a point basis, it wasn't very large on a percentage basis. Back in 1987, the Dow dropped 22.6% in one day. And based on today's close, that would be the equivalent of 5,392 points. Much more significant. The recent volatility may feel significant because we haven't had a drop in such a long time, and you may have not experienced a decline in your career. What we've experienced really is not all that significant, and we're going to have some more volatility coming forward. So let's take a look at the next chart. This recent sell-off has occurred amid concerns that a sharp rise in interest rates will eventually choke off economic growth. If the market sell-off occurred while the yield curve was inverted, or when the yield on the 10-year Treasury note was below that of the 2-year Treasury note, that'd be a different story. Put another way, when you see the 2-year yield is higher than the 10-year yield, that is an expectation that interest rates are lower in the future, and that's usually a sign of some sort of economic distress or the expectation that there's going to be a recession. Now, the yield curve has inverted, but that doesn't always mean that there's going to be a recession. However, it's important to note every time that we have had a recession, prior to that, there was the yield inversion. So we keep a close eye on that. On Monday, the 2-year yield closed at 2.08%, while the 10-year yield closed at 2.77%. And that's according to U.S. Treasury data. And that's a spread of 69 basis points, or 0.69 percentage points. And that was greater than the 51 basis point spread at the end of 2017. So, looking at the chart, and specifically the top line, you can see that the trend is still favorable with no inversion. So take a deep breath. We don't have an inversion. We're not there yet. All right, let's go to our next chart. Many on Wall Street define a correction as a decline of at least 10% and up to 20% on a closing basis from a significant peak. So with last week's sell-off and today's sell-off, the Dow is about 8.5% below its January peak, meaning we're still just in pullback territory. On an overall basis, global stocks have fallen from peak to trough by more than 10% in 2/3 of the years since 1979, yet in many of those cases, the markets posted a gain for the year. If the Dow falls 20% or more from the peak, however, then the decline becomes an official bear market. If this sell-off had tipped the Dow into a bear market or occurred while the Dow was already in one, our outlook would change dramatically. And understand that reading headlines about a bear market could affect how consumers spend, which in turn could put a brake on the economy, and that in turn would dampen investors' demand. It could create a so-called self-fulfilling prophecy. So we'll keep our eyes out. And although the sell-off could continue over the short term without an inverted yield curve or an extended decline into bear market territory, the current sell-off just looks pretty normal to me. Now in my next few videos, we're going to take a much closer look. And during that time, you are going to start setting up your game plan because I believe we're going to have a lot more volatility in our future. So for today, that's ChewDog Charts. Thank you.